Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlotnik, and today it is my pleasure and a privilege to welcome Kevin Bupp. Hey, Kevin.
Hey, Mike. Thanks for having me, man. Excited to be here with you.
Thank you for coming on a podcast. A couple of words about Kevin. He's a Florida-based real estate investor, top Apple Podcast host, and he's a bestseller, The Cash Flow Investor. He has over 500 million of real estate transactions under his belt, and he has a wonderful podcast called Real Estate Investing for Cash Flow. He's also a bike rider. He's done some cool things on riding a bike. So without further ado, Kevin, thank you again for coming on a podcast. But before we dive into business, tell us a little bit about you, your family, where you live, kids, cats, pets, the whole thing.
Yeah. No, all great. Again, appreciate Mike for having me on the show. So happily married, going on our 15th year this coming March. So very, very happy. 14 and a half years so far. I've got two boys, 7 and 10 years old. Jackson and Julian. Jackson being the 10-year-old, Julian being the 7-year-old, and both October kids, so both have birthdays in the same month, which is very convenient for mom and dad. But awesome kids, just enjoying life, and really the reason why we do what we do, at least for me, big purpose is the family, spending as much time with them as possible, and just be able to buy more time, right, and have flexibility and create memories with the family. So, but I guess as far as some additional context there, based in the Tampa Bay area. So I live over on the West Coast, just north of Clearwater. Most folks know at least that landmark, Clearwater Beach. So I'm just north of Clearwater Beach, and I've been down in Florida for 22 years, going on 23, and moved down here shortly after getting into real estate. I got introduced at a young age at 19. Bought my first single family rundown crappy property at 20. Used my $7,000 of bartending money I'd saved up to buy it, kind of teamed up with a private lender, and bought it, renovated it, turned it into a rental. And that was the first one. And that was where it all started back at the age of 20. And then, fast forward, in my early to mid 20s, ended up building quite a big portfolio of single family homes. Only with about 7 of them being in Pennsylvania, but I moved to Florida back when I was 22, and I wanted to move to a larger, more progressive city, something that actually had things going on. There was companies moving here, bigger population, and I found that when I moved here, Tampa became my home very quickly, and I very quickly met other folks in the real estate game that were doing much bigger things than what I had ever envisioned, and that really became the catalyst for me. Is just seeing the bigger picture, and again, started buying lots of single family homes. Got introduced to multifamily, many years back, and then multiple other asset classes within the commercial real estate field. And along that journey, 2011 was when mobile home parks came to my radar. As you know, that's what we mostly specialize in today, are mobile home parks. So, got introduced to mobile home parks 2011, bought the first one 2012. Now, 12 years later, still buying parks, own communities in 18 different states, and love the asset class as much today as what we did back then when we first started buying it, although more competition, so it's harder to get good deals. But even then, great asset class, very rewarding that we're helping the affordable housing crisis that exists here. I think it's the best product that can help really create a solution for the affordable housing crisis that we find ourselves in throughout the country. However, municipalities that don't really love us all that much, but it really is a solution. Unfortunately, it has a hard time getting traction with new product being built and things of that nature. So, but anyway, I've been at this 20 years, Mike. Got a great family that supports me in the journey. Have a lot of fun doing it, and I think that's the the quick snippet of me, my background, and also the family. So I'll shut up now for clarifying questions if you have any.
Well, that's a wonderful introduction of you, your family, kind of your journey. I think it's important to tell the story. So it's great to hear.
Yeah.
And just a couple of, I guess, follow-up questions or thoughts. So obviously, mobile home parks is an interesting asset class. We just had industry experts panel last Friday, and one of the folks on the panel is a good friend. He does invest quite a bit in mobile home parks, and it's one asset class that they don't build too many more projects.
That's right.
So you have a limited supply, at least from that perspective. Florida's seen a boom, apartments boom, and then they don't necessarily go through a bust, but you can oversupply the multifamily markets.
Yep.
Certain submarkets obviously see some negative rent growth. What's happening with mobile home parks rent growth? I'm just curious. They build a lot of apartments. Do they
Yep.
start grabbing folks who live in the mobile home parks? Hey, go rent an apartment, or it's just very different price levels.
Yeah, I mean, very different price
audiences.
levels. Yeah, and I think it's also a slightly different demographic as well, that we're serving. And there's different different classifications of even our asset, within the industry itself. Down here in Florida and then Arizona are really two, in California as well. But we've got a lot of what we like to call lifestyle communities down here. They're mobile home parks, 55 plus, but they're not necessarily affordable. Most folks that live there, they have a home up north somewhere or somewhere throughout the country, and this becomes like their kind of winter getaway, and they're attracted to it because there's a lot of activities happening. They've got multiple pools, they've got activities directors, they've got other folks their age that aren't working, that are there hanging out or maybe participating in various hobbies, and like it's more of a lifestyle. It's not necessarily a means of affordable housing. While it might be more affordable than that of a beachfront condo, it's still, in the grand scheme of things, not really affordable housing. And so, really the folks that we serve are, I'd say it's really a mixture of two. We get a lot of folks in our communities, depending on where it's located, that are maybe downsizing from a single family home. And they still like the yard, they still like the space, but they don't want to take care of the yard. They want simple living, and they want a lower cost of living. So that's a big piece of it. The other piece is new families, folks that they're having their first couple of kids. They don't make enough money to afford a stick-built home. They're both working, dual working households. They're working at Walmart as an assistant manager or at the tire shop. Just good, hardworking folks that are raising their family, their young family, and again, don't necessarily want the confines of an apartment. They don't want the neighbors above, below. They want a little bit of their own space. They want their own parking spot out front, which you get with mobile homes. But on top of that, you can take any of our, I always like to say, you can take any of our communities and any of the markets we own, and we own from, if you gave it a five-star rating, 1-star being like you don't even want to send your worst enemy into there, and then a 5-star being like those lifestyle communities, right? Like lots of amenity-rich type environments. We own typically like the 3 to 4-star range. So again, just good, hardworking folks. Clean communities, great locations, but also fairly expensive locations where the median home prices are north of $250,000 a year, sometimes as high as $500,000 a year. And so you can take any one of our communities that we own and try whatever the apple to apple comparison apartment would be in the local marketplace, whether it be a B class apartment, B plus class, A minus, what have you. And most often we're about 25 to 30% cheaper than that of what the total price point of living is in our community than that of the comparable apartment complex. So, we tend to attract, again, folks that are budget conscious, but also are looking for more of that home experience and not necessarily being confined into an apartment, and also have a longer term mentality, whereas maybe your typical apartment renter, might move every, I don't know what the data is today, but, every 16, 18 months, maybe 24 months, we've got our retention rates fairly high. We've got folks that have lived in our communities for over 40 years, they're almost generational in nature, where they even have maybe other relatives that live in the community. They've moved in there and they treat it just like a subdivision. To them, it's a neighborhood. And so, I don't know if that answers your question or not, Mike, but like that's, as far as what I think the original question was about rents, what we're seeing, kind of the same thing. I guess one of the benefits of our space, of what attracted me to it originally, was historically, and it still very much is. But historically, when I got introduced to it, it was very mom and pop. Like literally 99% of the parks were owned by sometimes the original developer, still maybe like second person in line within the family, but a lot of times still owned by the same family. Maybe they owned one community, maybe potentially 2 or 3, but they were still very much a mom and pop run organization. They didn't bring in outside capital. They weren't big institutional groups. There were a few in our space that owned large portfolios, but it made up such a minority piece of the overall percentage of our industry. And so, what we've seen as we've taken over these mom and pop properties, they've kind of artificially kept rents low over time. They don't really pay attention to inflation. They don't keep up with just smaller annual increases on a regular basis just to maintain where the market's at. And so for an example, like we're buying a park right now, and it's very much a 4-star. It's an institutional grade property owned by the same family that developed it back in the late 80s. The son owns it now, the son's 68. This is all they own. They don't own more than one. It's a big one though. It's 500 spaces. It's huge. The market rents in this immediate vicinity are on the low end 750, on the high end 825, and their average rent across the board here, and it's 85% occupied, so it's stabilized. I mean, it's a core plus type asset, but their average rents are 488, which is absolute insanity, and it's only because they haven't kept up with the market rents. So the industry has been trying to push and keep up with some type of normalcy and actually get rents a little higher, because it's not sustainable to keep these things artificially low forever. As taxes go up, as insurance go up, as the operating expenses go up, you got to be able to put the money back into the community and actually maintain it. And again, that's one piece that we saw also a lot of deficiencies with these old mom and pop operators. They weren't putting the money back in. They were just kind of taking out what they could, not necessarily fixing roads and keeping the infrastructure up to par. But so I think the industry has taken a positive turn with really more standardized practices that you might see in the multifamily space. And so it's common practice now to start getting rents up, and in turn put the money back into the community, invest, add amenities, just redo roads, cut trees when needed, and just make it a better life experience, a living experience for those that live there.
Yeah, I appreciate that overview. A lot of great nuggets. Obviously, education for me. I knew about the, let's just call luxurious communities. Maybe people drive their mobile home or their, I guess, gigantic RV, and they park it there.
RV, yeah, that's different. Yep.
Yeah, no, that's what I meant. And then to the, I guess, lifestyle more affordable. But what you described, at least the project that's coming up, where the market maybe 750, 800, and they're renting them substantially lower. It's a value add. It's
That's right.
a sort of a significantly undervalued, underpriced community that you can improve. Just like you can do the same in multifamily, the same concept. You have to improve the property, you have to do a lot of work, but you can bump up rent significantly. So
that
makes a lot of sense. So just curious, where you said they're all over the country, but where is your biggest concentration? Is it Florida? Is it near Tampa, or is it somewhere else where you find where you can get reasonable deals?
But funny enough, although we're based in Florida, and I've been in Florida a long time, and Florida, I think, is second to only California as far as total number of mobile home parks, like per capita. We currently don't own anything through the company in the state of Florida. Most of that is because everyone that's private equity institutional, everyone wants to be in Florida. Everyone wants to have Florida real estate. And it's been that way for the last, 10, 15 years. And so what we found is that there's a certain quality of asset that we like to own, certain demographic we like to serve, but also we got to be able to achieve certain returns, right? And it's very difficult with our retail cost of capital and then kind of our projections to buy assets here that would model out that we would be able to actually comfortably know that we could hit target returns for our investors. And while we would love just to own things here in our own backyard, I think the future is very bright for Florida. And so, no one can argue that point. It's just very difficult. The entry point is so high that our retail cost of capital, the economics don't work. I could lie on the underwriting. I could make them work, but most of the time they just simply haven't worked for us. And so we focus our efforts in other places. The Northeast has been great to us. The Carolinas have been phenomenal for us. But even the Midwest, we've purchased quite a bit. Indianapolis, Fort Wayne, other respective markets around fairly large, growing cities that have a lot of population growth. And so the Midwest, I would say, if I had to pick a region that has served us and our investors incredibly well as far as just profitability and just knowing that we can achieve returns going in, I would say it would be the Midwest.
Yeah, and I appreciate that. It's funny how you express it. It's funny because the same way I live in New York City, we don't invest that much here because everything is too expensive here. You can't get any, with some exceptions, it's difficult to get any cash flow here. So you find the markets that work for you. And Midwest, like I love India as a market. India is one of these steady Eddie, really good landlord friendly type of business friendly markets.
That's right.
Indiana is definitely a great place. And
Carolina
is a great story too. I've heard from a lot of people.
Yeah, absolutely. Yeah, I mean, so we've owned in and around the Raleigh-Durham market, a 45-minute to an hour radius all around that market. That's been phenomenal. And basically anything even remotely close to that, the medical triangle there, like it's a no-brainer. I mean, there's just lots of growth happening, lots of positive influence from just a litany of employers moving to those respective marketplaces. And so, and then just at least up until the last probably 5 to 7 years, it just wasn't necessarily on the radar of a lot of the institutional groups. Raleigh was kind of a little bit too small, for major institutional capital to be going there. But now it's not. Now it's absolutely on the radar. But we bought some great assets over the past 5 to 7 years in those markets. What was I going to say? Oh, back to Florida, to the point of just, it's interesting and you mentioned New York, I wish I would have bought every mobile home park that didn't even make sense in 2018 and 19 in Florida. Even if the underwriting didn't work back then, appreciation really carried that, right? I mean, literally what happened here during COVID, as far as home prices and values, I mean, basically turned into the equivalent of trying to live in California, right? Like it priced everyone out of the marketplace, and all values kind of followed suit, even mobile home parks. The mobile home lot rents around here, at least where I live, on average, I'd say are probably $1,000, $1,100 a month, which is probably back then they were probably $600 a month. They've almost doubled in value. And so again, that's appreciation. Obviously it's speculation at that point. No one knew that that would, number one, that, we would see double in prices in a 4 to 5 year span. And number two, no one thought that would happen as a result of COVID. Everyone thought the world was initially going to end and people weren't going to pay their rent. But as we know, it played out quite differently than that.
Well, let me ask you this question. So we saw that the post-COVID boom everywhere.
Yeah.
Then Fed started to hike rates, and then significant bust in valuations and cash flows happened.
Yep.
Especially on value add projects where you have to borrow with floating rate debt. So has mobile home park industry seen this sort of a correction with Fed pushing rates? I'm just curious. I don't know the market much. Is there a similar experience in multifamily where price of financing, availability of credit, leverage, all that stuff has basically dislocated the market the same way? And are you finding great deals today as a result?
Yeah.
So just curious, how is it?
We haven't, I would say that that floating rate debt and true bridge type product was not prevalent within our industry. Our deal sizes are inherently smaller than that. Our average deal size is a lot smaller than that of maybe your traditional multifamily deal. And so,
for example, how many lots? Like how many? Yeah,
I mean, so for example, I'd say like today our average transaction size is probably about 15 million. This would the example I gave you, that 500 lot park, it's a $40 million. So but that is somewhat of an anomaly. It's a very large property. We've got a property up in Indianapolis or up in Fort Wayne that's 740 lots. That was a $45 million deal. So but those are anomalies. That's not the norm. Most of our other parks are 150 spaces, maybe 200 spaces in size. Some even smaller than that. So again, you're talking $15 million deals, maybe $20 million deals on the top end, with those other ones being anomalies. But I guess to your original question, I've only one time in our history of owning parks have I ever used what we would classify as a traditional bridge product. That was a floater. Most of the time, if we can't get the deal, if it doesn't qualify for agency today, but we know that we won't buy anything if we know that it won't. It has to have we have to be able to see a clear trajectory of getting it from non-conforming for agency debt, Fannie or Freddie, to being conforming to where it will fall within their parameters. We have to be able to see a clear path how to get there in a couple of years. And so in those scenarios, typically what we'll do is we'll put a bank loan, whether there's a number of banks that are in our industry. There's also, the ones that we all know of, like Wells is a big lender in the space. But, we'll put traditional bank debt in place that have a 5-year fixed term. So we kind of use that we call that our bridge. It's not really a bridge. It's fixed. It's 5 years. We've got some flexibility there. We've got a time horizon that we're working with, and we're not, up against a time clock per se, like you might be with a traditional bridge product. And so I have not seen that much. There's been just like in every industry, I've seen distressed situations, and we had as far as acquisitions, last year was a great year for us. But most of what we bought seemingly was more distressed situations, maybe from partnership levels or other assets that were maybe dragging their funds down. They had to divest of some things to create some liquidity, but it wasn't necessarily, a property problem, a property level problem. But none of it, as I've seen, or what I know of, is a result of maybe what's happening in the multifamily space, where a lot of it's related directly to the debt vehicle that was in place, or the debt instrument that was in place, with a floater, with the, rate caps that are expiring. and ultimately, the cost to extend, the cost to put new rate caps in place, like that has just wreaked havoc on the industry. And so I have not seen that same scenario at all, and I'm not aware of anything. I'm sure there's a couple here and there that are ultimately having challenges, but it's not written about, it's not spoken about. I haven't heard it at conferences. I haven't heard that being the issue.
Yeah, I
If
appreciate
anything, the biggest challenge, honestly, is from a our biggest challenge that we see as I guess as buyers on the buying side is just, there's pros and cons of bigger institutional groups coming into the fray. The benefits are is that they just bring more positive attention to our space most of the time. But it also it gives a better option as far as an exit. What is our exit? 10 years ago when we were buying stuff, the exit was you sell them one by one because all that's buying are mom and pops, right? And so like you typically don't have a fund that's got 100, 200, $300 million that they're looking to deploy. And so historically that would have been the case. We sell them one off at a time. That was our exit strategy. Whereas today, being that there are big groups out there that want to write big checks, it's a much clearer exit. We could also, benefit from cap rate compression by selling a portfolio than that of just one-off properties individually. And so, but on the flip side of that, their cost of capital is typically less. They're really IRR driven. They're looking at, just short-term 3 to 5 year horizons, whereas we typically model things out 7 to 10 years. We like to be able to buy things and truly hold them for the long term if it's turns out to be just a phenomenal asset, because we know they're not making more of them, right? It becomes inherently more difficult every year for us to find great assets and great markets that we'd like to hold for long term, because the industry is very, not slowly, but very quickly becoming consolidated. And they're not making, they're not bringing new inventory to the marketplace. And so we got that weird dynamic to where it's a good supply demand imbalance if you find good assets and good markets, because they're not building more. So barrier to entry is there. But on the flip side of that, it makes it really difficult to find new deals and continue growing the portfolio. And so for that reason, we've got to have a much longer term vision and look to hold things for, typically we underwrite for 10 plus years. And we've sold things over the years, took advantage of some peak pricing in late 2020, 2021, and 2022, kind of pruned out the portfolio. And it just really set us up really well for 2023 to have a big year as far as new acquisitions are concerned. So again, but I'm not seeing the distress, not the same manner of distress as you're seeing in multifamily. I think if anything, Mike, what we are seeing is a lot of folks that got into this industry recently. It's not a set it, forget it. Everyone doesn't pay their rent on time. It's, there's a lot of moving parts of the business. There's not just managing the existing homes that are in the park, but a lot of times if you're looking to bring new homes in and fill vacant lots, you've got to have a whole sales and leasing strategy, just like you might in an apartment complex, right? Like a whole lease up, but more related to sales, actually home sales. There's a lot of moving parts. And I've seen a lot of folks kind of get into the business just thinking that it was a truly set it and forget it, and not realize how operationally intensive it really is. But I think that exists in any industry, right? But more so here, I'm seeing a lot of, if there is distress, I'm seeing it from that perspective of like, damn, like I thought this was gonna, I thought it was gonna buy me some freedom and time, but all I find myself doing is managing calls from the community manager and putting out fires, and that became the challenge. So,
well, I appreciate there's a lot of great nuggets here, and just sort of think a little bit, maybe ask some follow-up questions. So it has similarity to an operating business, which is important. I mean, we've seen this with senior living, independent living, assisted living facilities. We've seen this with a number of other businesses like car washes, etc. People talk about real estate. Even self-storage has some level of operating.
Absolutely.
And for those who don't understand, I guess it is not a truly passive. It's a lot more active, which is an important element. But that's where good manager can make a difference, while a weak manager can have it underperform. So
that's right.
Understood and agreed. And interesting to learn that it's more of a fixed rate. Very few people bought on floating rate debt, although interest rates are impacting obviously cost of financing for everyone.
Yes.
The people who are buying today, the experience with the higher rates is drastically different when the rates were low. And so all that, these market forces exist. But the lack of supply is very interesting. You have no supply, while multifamily has seen significant new supply coming into the play. So it's a very different experience from that perspective.
That's right.
Where do you see forward opportunities? You said you don't have that much product out there, because the product is limited new product, number one. Number two, some institutionalizing happening. People are coming in, at least bigger checks, want to buy $100 million portfolio. So you have no limited product. Your bargains happen typically when mom and pop needs to sell. And are you finding great opportunities to invest? And then the other follow-up question, if you have truly very long time horizon, like 10-year time horizon, for a lot of investors, I know personally, it's too long. How do people get comfortable writing a check into, and do you run a fund or do you run like one-off syndications? Just curious how you do it.
Yeah, we run funds. We're currently on our fourth fund, but I think there's a couple questions in there, and I'll try to remember them all. So I guess I'll hit on one that's top of mind, related to like just our investor base. I mean, most of the capital that we have is retail source capital, and I think years back when we really started kind of evolving our business model and really identifying what the long term looks like in this asset class as it becomes more and more consolidated and as it becomes more difficult to find deals. We're still finding deals, but we definitely got to turn over many more rocks to find those opportunities than what we had historically done. And as we've identified that and also determined that we'd like to hold these, given the opportunity as long as possible, like who's the right suited investor, to put capital in our fund. Like you want to make sure there's an alignment of interest there, right? And so we classify in like three buckets, right? You got those that are willing to take on inherently more risk, but they need home runs, right? Like they're looking to keep the velocity of the capital rolling. They're maybe looking to take slightly more risk for a slightly bigger reward on the back end, right? But they're still kind of growing their wealth. Like they're at the beginning stages growing wealth. They need to recycle things on a regular basis. They're not looking to just like set it and forget it for the next 10 plus years. They need to turn it into much bigger checks. Then you got to kind of have like the complete other end of the spectrum. You got the guys that they made the wealth. They just don't want to lose it. They don't want to deal with the tax consequence every 3, 4, 5 years when you've got recapture and capital gains, and maybe not another vehicle to put their money into, right, to help offset that. And like to them, that's almost as big of a headache as like they've already been there to grow it. That was a headache when they grew it, but now they want to focus on other things, like just give me my distributions on a quarterly basis, make them consistent. I don't need to hit home runs. I'm okay with singles and doubles. Just don't lose money, make money, but also don't lose money, keep it safe. And also don't give me a headache every 3 years when you go to sell something and you got this big, again, recapture consequence and tax bill that I got to deal with. And unless you've got a solution ahead of time, don't bring me that, because that's also a problem for me. And so we've really, and you got the middle bucket, right? It's kind of, they're somewhere in the middle there as they're growing their wealth, but we really have honed in on that wealth preservation bucket, finding those that have the same alignment and interest. They like the asset class, they like the tax benefits, but really they want consistent distributions on a quarterly basis, and just ensuring that their money is safe, secure, and it's with the team that has a similar alignment of interest. What they do, again, just they want to focus on other things in their life, and they want their money safe, and again, don't want these challenges that might exist every 3 to 5 years with the normal kind of buy, fix, and flip model. So that's it. I mean, like that's how we find folks that are a good fit for us, and how we think about things. And again, I think the merits of the asset class really sell themselves, and also the supply demand imbalance. It's kind of hey, like there's long-term opportunity here, but the long-term opportunity is today finding the great assets and building a portfolio out of it, so that in the long run we could really benefit from those tailwinds that exist in the space. So. There was another question in there, Mike, and I think it was before that one, and I forget exactly what it was. And I knew that was going to happen. Hopefully you remember, but there was a couple questions kind of layered in there.
A different line. It's fine. So
yeah, sorry.
This helps. At least you explain 3 sort of groups of folks, and the group you're focusing on is a little bit more towards
wealth preservation. Yeah, they've made the wealth. That's right.
What kind of rates of return? I'm just curious. Exist in your space? What kind of cash on cash, and what's the total annual return generally for investing into this?
Yeah, I mean, so we model everything out. We always look at a 5-year projection, but as well as a 10-year. But realistically, we like to think that the 10-year is the truer picture. Because surely we could, the IRR looks much more attractive in a shorter duration. And so we look at both, but realistically, we want to be on a 10-year model. We want to be able on a deal level somewhere between 14 and 17% deal level IRR, with it kind of rolling out to be somewhere in the 12 to 14% range if we're looking at a 10-year exit horizon.
That's IRR.
That's IRR, right?
What about cash flows?
Yeah, so on a cash flow basis, we like to be like our cost of capital, our blended cost of capital is somewhere in like the 8.4 range, I think, at this point in time. And so like we like to know that we can actually get to upon stabilization that we can actually pay out on a real time, what the real time weighted cost of capital is with cash flows. And so, we like to shoot for that 8 to 8.5%, cash on cash return. Typically by year 4 is like most of our business models kind of run a range of, I'd say 2 years on the short term, and on the bigger properties, it's normally somewhere in like the 4 to 5 year range at the longest. But like somewhere between year and 4 or 5, worst case scenario, we'll hit stabilization. We like to be able to basically achieve what that cost of capital is in terms of a cash on cash return.
So 8.5, once you stabilize, and
that's correct.
The beginning, is there any cash flow, or it's like?
Yeah, and a lot of it's fun. So we do everything in a fund structure. So like right now, we launched our current fund, SCI Growth and Income Fund 4. We launched it last October. We're still in buying mode. We intend to start making our first distribution January of 2025. So right now, we're still bringing new deals into the fray. We're still going through the stabilization game with the existing properties that we've purchased. They're all different stages. And so we always set the expectation that like we're not paying out we typically don't pay out cash flows for at least the first year of launching a new fund. I think our last fund, Fund 3, I think it was about 18 months before we started making distributions. But again, it's kind of difficult, and there's a little bit some convolution there when you're making distributions out when you're still bringing fresh capital in to buy new opportunities. And so we like to kind of wrap up the buying, and then at that point in time start making distributions. But I'd say, I can give you an example of Fund 3, since we're not making distributions in Fund 4 at present. Fund 3 is paying real time about 6% right now. Yeah, and Fund 3 wrapped up its buying activity August of last year. So there's still a couple of deals in there that are actually, kind of in the turnaround phase. Half of it's stabilized. The other half is still in the midst of his business plan. But we're paying out real time. I think it's like 6.2%, give or take.
Yeah, I appreciate the explanation. So it makes sense. It's a couple of years, or year and a half of value add, then you turn into some light cash flow. You have an increasing cash flow. It's really patient money, and the bottom line is,
that's right.
This is not for somebody who needs immediate gratification. It's not an immediate income product. It's a mix of some kind of a little bit of a growth of value add.
It's like we call it growth and income fund. I mean, it's a little bit of both. There's a little bit of both in there.
It makes a lot of sense. And how many typically assets do you put in the fund? Is typically how big of a package, and sort of what's the size of the fund, equity raised, and how many assets?
Yeah, so currently, like the fund that we're raising in right now, it's a $100 million fund. There's currently, there's about 70 million, give or take, of assets that are currently in the fund. We've got another $10 million deal that we'll be closing on in the next 2 weeks. And then we've got that one I'd referenced to you earlier. That one's roughly a $42 million deal. And so that will get us pretty darn close to fulfilling that fund. And then ultimately, the perfect plan would be to roll out literally just a clean and concise, a new fund every year, every calendar year. We'll probably miss the timing on it, but generally speaking, that's kind of where we're currently at with the existing fund. And then how many, so I guess to give you a better frame of reference, yes, how many deals are typically in a fund. So this Fund 4 will probably end up with 7 properties, 7 or 8, depending on how it all shakes out. Fund 3,
the average size around 15 million. That's what it's.
Yeah, so like that's it. So like the thing is like the business has changed. It's morphed a little bit. It's evolved over the years. Even our business has, where like just there's better scalability. There's more efficiencies in larger deals. And so like Fund 3, for example, it's got some smaller mobile home park assets in. So Fund 3, our last fund, it's got 13 assets in the fund. And it's slightly bigger in size than 100 million, but it's got some, $4 million, $5 million properties in there. Whereas the smallest property in our current fund, I guess will be probably the one we're closing on 2 weeks, will be 10.2 million. So that would be the smallest. And so it's a great deal of variance there between maybe what historically our average deal size would have been to what it is today. And I think it's an evolution of the business, but also just even a slightly higher quality product. I think we've done some really heavy lifts over the years, and surely not scared of hard work. However, there's a certain drain on resources and inefficiencies that ultimately come from doing too many, heavy value add projects all at one time. And so we've kind of evolved more to a blended of a stabilized value add, like the one I spoke to with, to where the big levers on that one are just basically, getting rents to market. And then there's some very minor infill, but generally speaking, it's a high quality deal. It's in great condition, great infrastructure, stable cash flow out of the gate. It's like that's, more of a core plus stabilized value add property. And then what we can blend in now if we want to do a little bit of a heavier lift, but we won't typically take on more than one or two that require massive infill, millions of dollars of CapEx and just lots of time and attention. So like that's become kind of our primary game plan, is mixing the two together versus that of historically we used to just do all fairly medium to heavy value adds. Like that was the game plan. And on a model it looks great, but once you start doing many of those at the same time, there's lots of other trickle down inefficiencies that start playing out through your organization, because we're all vertically integrated. We've got all of our team in house, but there's only so much bandwidth that you have as an organization. No matter how many people you hire, there's still breaking points in that chain, and it becomes very difficult to do those really big projects and do a lot of them at the same time. So,
yeah, a lot of great wisdom points here, and I appreciate very transparent, open conversation. A lot of people don't understand there's a complexity of growth. As you bite more and more, can you really chew all this stuff and chew?
That's right.
Chew
it all the way before you swallow, right?
Yeah, quality work, and it is. Yeah. And I understand funds. I understand funds really well. So blending in some income into growth and growth into income gets complicated, because you're mixing things up and you don't always get the exact outcomes that you want. But the operating execution is a key, and that's you have a great point. Projections and pro formas on paper quite often are very different from the real world. It's kind of a funny thing that most people who raise capital need to make things look good on paper, because otherwise you can't raise capital. And at the same time, it's hard to hit if you get too optimistic or too what's the word for it? Too aggressive in your assumptions and on the execution. Then you wind up underperforming the expectations.
That's right.
And it's a beauty and a curse. So
I think they say there's one promise I can always make you, Mike, is that with my pro forma, it's either it's going to be wrong or wrong. Either it's going to exceed expectations or it's going to miss the expectations. It's never going to fall right on the mark. There's no way. It's never happened in the history of real estate investment. It's never happened.
Well, it's kind of a funny how a lot of people don't really understand this, and this is going to be a great episode, because you are explaining how the real world works. It doesn't work exactly how it's planned. In fact, the last point is super important. Very few things hit exactly the way you project. They get better, they get worse. Sometimes a lot of things get worse. When the interest rates rose, a lot of things got worse. And when the interest rates fall, a lot of things can get better. But at the same time, there's volatility in execution. Every market is different. What kind of cap rates these things trade at? I'm just curious when you. Yeah. And I know if you sell the package.
Yeah, I mean, I can spew off the Green Street data that just recently came out. I mean, like it is held its ground and has the lowest cap rate of any sector right now, at least in the last quarter of the reports. So I think per Green Street data, the average it's like a 4.7 cap, which is insanity when you really think about it. But I mean, it's
4.7 cap. Today,
yes, it's insanity. And I don't know, I don't know as far as granularity of who all they survey with the Green. I mean, Green Street's a reputable source. I don't know exactly who all they survey. If it's just the publicly traded companies that have institutional size assets that is a primo product, or if they take a blended mix of all the above. I don't know the answer to that. Nor will I probably ever get it. But with that being said, I will say that it's still competitive. There's a vacuum in our marketplace right now, like lots of institutional groups. Just given that the debt markets, lots of institutional groups of big players have kind of been pencils down, either for that reason or maybe they just got out in front of their skis over the last couple of years with buying aggressively, and now they're more on an operational focus mode, and so it's created a little bit of a vacuum in the marketplace, which we kind of see as the opportunity to get in and buy, while the buying's good. But even then, cap rate's important going in. A lot of what we buy, like the core plus deal, that's stabilized value add. I'll use that as an example. Our going in cap rate on that is just shy of 5%. So it's generally speaking, it's negative leverage. However, again, speaking to, the rents are 34% below market. And then it's a phenomenal submarket with incredibly expensive homes. And so there's an opportunity for us to finish out the project and infill the remaining 60 lots that are there, and feel very confident in our ability to do so. The average occupancy in that marketplace is 97%. And so, the demand is there, the absorption is there for the homes. And so we don't necessarily look at what's the going in cap rate on that deal. It's like, what's it going to look like in 3 years once we execute, 90% of that business plan. And I feel very comfortable in our ability to create healthy returns, but also even more than likely, like our exit on that deal, to our underwriting, our exit, we're still modeling a 6% cap rate on the exit, which I think is overly conservative, given where the data is at today, and knowing that, to your point, when rates go down, typically prices, buying activity is going to kick up again, and more than likely will probably continue to drive prices up. I can only speak for our asset class. Again, there's no new supply. There's not like an absorption factor that has to occur like a multifamily. So maybe there's a little bit of a lag in multifamily of prices getting back up, but inevitably that supply will get occupied. And we haven't been building anything now for the last 3 years, right? So then we'll go through that same cycle again, where there's a lack of housing, and we're running at a massive shortage, and then we'll run through a frenzy again of trying to build. And anyway, it'd be interesting to see what the future looks like. But we do look at going in cap rates, but it's I would say that's probably the least important factor for the most part of our underwriting, at least when there's a value add deal that we're looking at. So I don't know if that answers your question, Mike, but yeah.
Yeah, it does. It actually does. There's this good amount of similarity to classic self-storage too. The cap rates are still pretty low, and you buy the negative spread. Everything you mentioned on the fact that some of the institutional players are pencils down because of the cost of money, right? But because limited supply, the cap rates haven't really expanded heavily.
That's right.
And the same is true in self-storage, interestingly enough. I think what has happened is probably leverage has gone down somewhat. Maybe you've
That's
seen
correct.
this. So with lower leverage, you can still pay similar cap rate. You just have to persevere a little bit longer. And the value add component, that makes total sense, right? You're not buying based on a current cap rate. You're really buying based on what you can stabilize. Where can you get the property? So if the math makes sense a couple of years from now, and you can execute, then you can make the numbers work. But it's very
like we want to see like our kind of threshold is like an 8% yield on cost, year 5 yield on cost. So that's kind of like our baseline that we work from. Again, depending on what metric is important to the who's putting the money in, or though, however they want to hear it in their terminology, whether it's equity multiple, or yield on cost over a 5-year span, or what's the average cash on cash return over the lifespan. So by this using that, knowing that you're fairly sophisticated. I mean, you understand the fund business and all that. I mean, we look at all of it. But I would say that upon 5 years, knowing that we never take a project that would take us more than 5 years to stabilize. And in fact, like I said, most of the time it's somewhere in like that 3 to 4 year range at the most. So we look at like a 5-year yield on cost, and we like to have that 8% as the floor or the minimum that we shoot for.
No, it's a good target. 8%. I think some similarity in this self-storage industry too. I'm not, I don't know your industry enough, but if you wind up with 8% yield on cost, and the prevailing cap rates still trade, as you said, under 5, even if you underwrite for a 6 cap exit, you still can make pretty decent returns.
That's
you
right.
just got to have enough of patient money that can persevere for you to execute value add. And ultimately, either you refi at some point and the rates fall, or you sell as a package. But it is a patient, long-term horizon, which is nothing wrong with that. It's more of it's kind of a funny thing. I'll just add one comment. I'm reading it's not a new book. It's been around, but this is a classic way to think. I'm going back to the book is called What It Takes. Steve Schwartzman, the founder of Blackstone. And one of the principles they've implemented there is never lose money. I kind of like what you said, is focus your investing on the deals that you may not give people fantastic, ultra exciting returns, but at the same time, you expect never to lose money as part of your strategy, which is a positive. It's a great way to think about it. So
what's that book called again? I like that. I've never heard of it, so I'm going to mark it down.
What It Takes. What It Takes, and Steve Schwartzman.
Yep.
He's one of the most profound names in commercial real estate. Again, Blackstone is one of the largest institutional buyers, and it's fascinating how they evolve and how they think. And as I'm listening to the book on Audible, trying to pick up some of the basic nuggets, how they think, how they run their investment committees. It's really a great way to think if you're an investor trying to learn, grow, and improve. Some of these practices make a ton of sense. Now, the book is a story. It's a journey telling book. It's a good book.
That's good. I like that. I actually prefer that.
Information, but you get enough of these kind of high level ideas and some of the philosophies. What's really interesting how they run the investment committees, where they have veterans and new associates, and everyone gets a chance to speak, and you don't get a big bolus to override everyone else.
I love that.
Agree or disagree. So at least everyone gets an opportunity to provide their input, and if they have something to say, they get an opportunity to participate.
Yeah, I love that. I love that. I mean, honestly, like I'm sure that fosters things. It fosters way more benefits than just ensuring that you're buying a deal that everyone's on board with. But I mean, just retention. I can imagine that even having that type of structure where you've got everyone's input, all the way down to a much lower level, you're getting everyone's voice heard. Everyone's at least has an opportunity to to share their voice and their opinion on something. Just the feeling of inclusiveness there has got to be much greater than that of where it's just big boss man. That's the committee. That's who makes a decision. They don't give a shit about anyone else within the operations or the other, maybe the finance side of the house that are going to ultimately be dealing with, this particular project or this property after it's purchased. So I love that. I'm excited to read that book. So I'll make sure I add it.
And we have to wrap up. I just wanted to say, as I was listening to, and of course, this is an evolving process. But people who pitch the deal, people who found the deal, people who identify, you may have a team member, your acquisition director, or somebody who's looking, they are motivated. They've spent a lot of work, a lot of time and energy looking for the deal. And they have a bias, whether they like it or not. As much as they can be objective, they have some subjectivity. So you definitely want to have team members who have no dog in the fight, but they do have long-term alignment to make sure that the company buys the right type of assets and they invest. So that kind of philosophy helps, and at least in an investment business, sometimes you do need a contrarian voice. Sometimes you need that person who's going to give you the view that nobody wants to hear, and that view may be important at that time. So,
nope, I agree with you.
How would folks reach out? How would they? Is that a good website?
Yeah. So, I mean, really two different places to track me down. I guess, first and foremost, our company, Sunrise Capital Investors. If you want to, learn a little bit more about us and our business model, we've got a lot of resources on there. We're pretty transparent with the deals that we've done. We provide third-party reports and appraisals and a little bit of an overview of the business model. And, so just lots of fun reading that you can find on there. But you can go to investwithsunrise.com. There you can also find access to our current offering and read about that as well. And then me personally, kevinbupp.com. It's just my first and last name.com. I house my my podcast on that website as well. And then one way or another, either one of those contact us links on either one of those websites will track me down fairly easy. And then you can my last name's unique enough to where you can go type it into Facebook, Instagram, or LinkedIn and quickly find me as well. I don't think there's probably more than one or two other Kevin Bupps in the country. Pretty easy to find.
This is very smart way to get a great website with that kind of easy name. My name is a little harder, so I had to go BigMikeFund.com. For you, it's KevinBupp.com. That's just easy to remember.
Short and sweet. Yep, I love it.
Thank you, Kevin. I appreciate your wisdom. Thank you for coming on a podcast.
Mike, thanks for having me on. It's been a pleasure.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.